The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on back here to the Diagnostic Trading Hour. And thank you for joining us today and each and every day right here on TFNN.com. Over 9 hours of live radio from traders with all different methods to trade. And so you can learn a whole lot right here. And make sure you can tune us also on, you're on the web, on your mobile phone, TFNN.mobi. And you can check out archives of your favorite shows as well under the Tiger TV box over there on TFNN. So let's go ahead and check it out. We got the market deciding to go back and get some orders there, moving on back up. Right now we have the S&P up 24 points. We have the Nasdaq up 46. We got the Russell up 19. We got the Dow up 173. Gold's up 17. Silver is up about 1% right now. We got copper up almost 1%. Oil is currently down 36 cents right now on the day. We got corn up 13 bucks, soybean up 20 bucks. So corn definitely being a big mover along there with the Russell, both over 2% right now. And let's see here. We got euro dollar is up 139 pips. So sort of quiet yesterday, but decided to move today. Pound dollar up 72, Aussie dollar up 65, euro yen up 2.3. We got pound yen up $1.84. We got U.S. yen up 83 cents. U.S. CAD down 24, along with the U.S. franc down 85. And one of the things that you can always look at, you can always learn with the market is, I talked about this before on shows, but the market doesn't move up because there are buyers. That's sort of a false assumption, all right? Think about this. There's always a buyer. If there's a seller, there's a buyer. If there's a seller, there's a buyer. If there's a buyer, there's a seller. That's always there. The market doesn't move up because there are no more buyers above the market. Okay, nobody is offering to buy above the market. The market doesn't move down because there are sellers, because they sold all the way up too. Okay, the market moves down because there's no longer sellers below the market. So when you have a massive down day, okay, the question to really ask, the question to figure out, like we had yesterday with that massive down day, is how many people are left to short the market. Now, could it keep going down? Of course it could. But you don't want to assume just because you had a down day that you'll have a following down day. So you may have 2 days in a row like gold. Of course, those 2 days were two of the biggest moves, I want to say, since like the 80s or 70s or 60s, maybe 64. I have to go back and look at my stats. But I think that's the two biggest day moves since 64, and I want to say it's the biggest move in gold since like 92 or 93 in a single day. So the 2 day move setting a new record here, and so that's a day where it did continue down. Today gold's up at the moment, so up 17 points. Now that's nowhere near the 130 or whatever it moved on down yesterday, but are there more people below the market to continue to sell? And the reason you sort of want to look at that and see that is it helps you not become so tied up in the trend that you're going to, hey, this thing's crashing, it's going to 1,000, and so I'm going to keep shorting gold and getting killed on it, because you want to move where the market's moving, where the charts are moving. You'll see that best in the market. The charts will reflect if there are buyers above the market or sellers below the market, because of course the chart will go there. And now that's where volume comes in. Speed of volume comes in, the velocity of that volume. And a lot of times you'll go up and you'll get an expansion on price without getting volume. And so what I've seen when that happens is that basically means one of two things. So when price moves up but volume doesn't, it's like it's really low. Okay, and I'm not talking about it's been low. I'm talking about like it spikes up and it's really low, or it spikes down and the volume's really low. Then you have two possibilities, and it's important to know there are two possibilities because you can use this to your advantage. And so let's say you're long, you're buying in the market. It's moving up, moving up, moving up. All of a sudden, it just pops up but you notice there's no volume on that move. Okay? Well, that two things, we'll go get those two things now. I know you're wanting to know what the two things are. Often that will signal a reversal. They popped up to see if there's any more buyers, and they filled the few buyers that were left, but there really wasn't any buyers above them. And so if they pop up and they find there's really not anything there, they can't see any further in the depth, showing a lot of orders sitting there, then the market exists to fill orders. That's the only reason the market exists. And so it goes back down and it'll drop. So it'll reverse. So if you see an expansion on volume or expansion on price without an expansion on volume, then one of the two things is that it will drop. Okay? The next thing that you'll often see is they could be testing. They go up there, they're like, hey, for the next 2 points or whatever, 3 points, there's nothing here. But they see there's a whole lot of volume right above that. If they see that, it'll often pop up, pull back, and then move towards that area. So you're saying it can go up or go down if there's an expansion on volume, expansion on price with no volume. Yes. Well, how is that helpful? That sounds like 50-50. Because if it's going to reverse, then you should expect a reversal, which means you could put in, when you see that, an entry to go short below where the expansion happened. And you could actually trend that on up for the next few bars. And you ought to see if that expansion happens within a few bars. You should see if a reversal is going to happen because of that expansion on price without volume. Within the next 3 bars, it should break one of the previous bars' lows. Okay? So that lets you know, hey, I should expect a reversal. Well, how does that help me on buying? Okay, well, on buying, it's not really an entry signal because within the next few bars it can easily go back down. But if you're long already, okay, this means tighten your stop. Because either one, a reversal's coming and you want to get out, or two, it's going to take off and it won't hurt you to tighten your stop. So it works for you if it reverses, it works for you because you helped lock in your profit. If it takes off, great. Now you can manage your stops from there. But that's a point at which you want to reduce your risk of giving back the profits you've put in, or that you have, because that is your money. A lot of people think, well, until I close my trade, I haven't lost or I haven't won, and I know that, I feel that, I understand where you're coming from when you say that, but the reality is, if you're down $500, you're down $500. You may make $500 back, you just haven't realized the loss, but the loss is there. Just like if you're up $1,000, you have $1,000. If it comes back down to 200, yes, you made 200, but you lost. First, what happened was you actually made 1,000 and you lost 800. You netted a $200 profit. Okay, so the profits you have are yours. The losses you have are yours on open trades, and so you don't want to look at it as the reverse. Now, you don't want to make your trades based on P&L. So I talk about this a lot when I'm talking to traders. Is hide your P&L if you need to, okay? Manage your risk. Don't take on too many contracts. Have your stops where you know what's an acceptable stop based on a risk. So you can say, that type thing. Know what your risk is on the trade. I'm not saying don't know your risk, but don't get out of a trade because it's up, and don't get out of a trade simply because it's down. Because your profit and loss has nothing to do with where the market's going to go next. However, if you make your profit and loss something that you think is going to somehow impact the market, then it will go right to where you don't want it to. Because you'll get out, and then it'll go where where you wanted it to begin with before you got out, and you're like, So you don't want to make it about P&L. You want to make it about what's on the chart. If the chart is telling you to go long, and you follow your rules, that way, because how can I put this? That way you don't take your profits too soon. One of the things I was writing today, I was talking about, in trading, you don't want to be a pig, you don't want to be a sheep, you don't want to be a jackal, you want to be a lion. And I sort of got that methodology, that idea, sort of adapted, I guess, from Phil Hellmuth, and I changed it over a little bit. And not that I'm a big poker player, but I know some guys who are, and obviously he's a world-class poker player, and like not a gambler. So if you didn't watch the show yesterday, just between a trader and a gambler, we talked about that, and I'll keep expanding on that subject too. But you have to be very methodical, and a pig is going to go in. They're going to take a trade too soon. They're going to go in and they're going to hold on to a losing trade too long, and basically have a loss become a larger loss than they should have had to begin with. They're going to put on a position too large. They're also not going to get out of a profitable trade. They're not going to trail their stops because they don't want to miss out. And, let's talk about, what causes us to do that as traders. Well, if you don't take your stops, if you don't get out of your trade, if you put on too big of a position size, then that means that you have an assumption. And that assumption is that you're assuming that you're going to be right on your trade. And you want to be right on your trade. And therefore, I want to get in because I assume this market's going to go up. Not because my charts tell me to, because I just got a hunch, I got a feeling, I got a gut feeling, I got a tip from a friend. I saw a news alert come across the wire, and that means it must be going up. It's an assumption. And so you operate on that assumption, and therefore you totally hose yourself. And so that why else would you put on a high risk trade unless you think, hey, it's a sure thing, or it's probably going to be right. And I talked about this yesterday. I said, you need to basically assume that if you had 100%, let's say out of 100 trades, let's just say you have a track record of 70% winning on your testing or your trading or whatever. You always need to have an assumption that this trade, there's a 50-50 chance it'll be a winning trade or a losing trade. And because what that does, it gives you the bravery, the lion side, to take the trade if it follows the rules. But it also gives you the intelligence of the lion side of, lions, they don't attack a herd, okay? Right? They go in and they wait, they find one that's injured or off by itself or whatever, and they'll attack that one. And so they're courageous enough to go make an attack on another animal, right? But they're wise enough to not try to take on 50 of them at once. It's sort of funny. My wife's favorite animal is a giraffe. My favorite animal is a lion. And giraffes actually can decapitate lions. So they don't attack giraffes too often. With their hooves, they actually can, one swipe, they can decapitate them. And so they're probably not going to attack that animal. So let's talk about a little bit more about this when we get right back from this break on how to avoid being that pig and that sheep in your trades. Stay right there.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces. And over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by Backtech Environmental. For more information, just click the Backtech banner on the front page of TFNN.com.
All right, welcome on back here to the Diagnostic Trading Hour. And just going through several different things in the trading psychology. You know, and I talked about yesterday that sanity comes before stewardship. Sanity comes before risk management, because without sanity, you won't manage your risk. And if you have any questions, by the way, about this topic we're talking about today, or about stocks, ETFs, charts, anything, feel free to give me a call right here at 877-927-6648. And so let's go ahead and go a little bit more into the subject, trying to avoid that. So the biggest way to avoid being the, you could call it the prideful pig, all right, is to have correct assumptions. And I talked about it yesterday. Have that humility of assuming that this is a 50-50 trade of being a winning or losing trade. No matter how good my system is, no matter how much it wins over a course of 100 trades, I don't know which one this is going to be. Is it going to be a winning trade or a losing trade? And the whole reason that is absolutely vital that you are 100% honest with yourself is because if you don't, you will over risk. You will put in too much capital. You'll put on too large a position. You won't take your stops, and you won't trail your stops, and you'll give money back. So you're either going to give it back, or you're going to take a loss, or there's so many different issues that happen, but they all happen because of the assumption that this is going to be right. So, and people get, well, it's because I want to make money, because I don't want to take a loss. And okay, I get that, but the only reason you wouldn't take a loss, the only reason you wouldn't allow your stops to keep trailing is because you believe that the trade will win. Otherwise, you would get out, right? So it's an assumption that the trade is going to be a profitable trade. And you need to have the assumption that it may or may not be, and it's 50-50. Over the course, it should add up. And if I manage my risk properly, it should add up. And, one example I, give people a lot is I'll say, if I told you a system, and I have systems like this that win 9 out of 10 times. It's pretty easy to make a system like this, by the way. 9 out of 10 times wins. Here's the issue. Every time it wins, it makes $1. Every time it loses 10. So you're a great trader. You have a 90% win rate, but you lose all your money and then some in one trade. Because you don't have the assumption that the 10th trade could be the loser. Because you won 9 times in a row. I mean, we're talking about the worst time we start doubling up. We start adding on more contracts. You start compounding. Because you have successful winning trades, one after the other after the other. Sooner or later, you're going to lose. Okay? And it could easily be this coming trade. But it also, this coming trade, the next 5 trades could be winning trades. So it doesn't mean you don't take them. It's not like you don't want to operate from fear. You want to operate from reality, from the humble, honest estimations of oneself that this could win or lose. Therefore, I need to manage my risk appropriately. And if it is a profitable trade, I need to manage my profit appropriately, so that way I maximize my profit. Or at least try to turn it into where a winning trade doesn't become a losing trade. Like a lot of times what I'll do is when certain things at certain points in the market, the way that I trade, the way that I trail my stops or whatever, if I see something in the market, at the very least, because sometimes I want to give it room to move or whatever. And sometimes when I give it room to move, but I don't want to give it room to become a loss. So if I had, a $200 risk on a trade, I don't want to take that $200 loss. Now, I'll set it, right near break even, which means I may lose a little bit in bid-ask spread and commissions or whatever. But let's say, I'm up $150. Something tells me, hey, I need to tighten my stops. And I go, well, this thing could easily just oscillate. So I know that it could oscillate a little bit and then pop right back in my favor, go down. So I want to give it some room. So I sort of have 2 choices. Give up the big winning trade possibility or get out at break even. So now I removed my risk. Okay? I assume that, hey, if it gets back to break even, it could keep going down. So I'm not going to the assumption that I'm going to be right. Therefore, I'm okay with moving to break even. And sometimes that will work out really well for me and I'll make a whole lot. Sometimes I'll end up giving back the $100 that I made on the trade. But I had a $200 risk to begin with. So now I didn't lose anything. It's like I never placed the trade. I can go into the next trade with absolutely no, it was just a voided trade. Okay, yeah, there's a little cost, but if you're worried about the pennies, you're in the wrong business. The pennies do add up. You don't want to churn them. You don't want to just, throw money away. But I'm not worried about taking a $5 hit when I had a $200 risk, So that's sort of where I'm going on that. So the only way to get that pig under control is to have an honest estimation versus an estimation of loss. Now let's talk about the sheep after this break. We're going to come in and we're going to go into how do you keep yourself from taking profits too soon and being afraid to pull the trigger when you have a good setup. We'll be back right after this break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, Nasdaq, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit, and on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, welcome on back here to the Diagnostic Trading Hour. So going us through a variety of trades is all we got to check out here, but right now we're focusing on just some of the trading psychology side of things, which, like I said, trumps everything. Because you can have the best system in the world, you can have the greatest risk management in the world, but if your psychology is messed up, you're not going to follow it, so it doesn't matter. So we talked about, the only way to keep the, pig in check inside you, the greed side, is to have an honest estimation that any trade could win or lose. And that's why you need to follow your rules on, profit management. You need to follow your rules on risk management. You need to follow your rules on getting out of a trade, on size and position. And by the way, the best way to determine the size you should trade, it's a very simple formula, okay? Decide how much you will risk per day. And I want to say Alexander Elder talks about this. He talks about getting eaten by the sharks and getting eaten by the piranhas. And the shark is that big bite. So let's say you have a 5% risk max on your account in one day, okay? And I mean, you may have large, you may have smaller, but this needs to be defined. So a series of trades in a row, once you hit that amount, you're done, because you don't want to get eaten by the sharks. I mean, if the sharks hit you every day at 5% a day, it would take a long time. It wouldn't take 20 days, because 5% means it gets smaller and smaller and smaller and smaller. So it would take a long time before you got eaten up. So you got to have that risk management in place. And then also you don't want to get eaten by the piranhas. That's all those little losses. And so you want to set that size, okay, so whatever that size is based on your risk. So let's say you started with, what does it say, 10 grand. And we'll go in here, and let's see, maybe I can make this even a little bigger, make it easier to see over on Tiger TV there. I've got to get out of that so I can zoom my, there we go. So 10,000, and then what we'll do is a simple formula, and we'll say, okay, times 0.05. How long could you last? If you were a wretched trader, okay, as unfun as that sounds, and you lost every day getting eaten by the sharks, and you kept a 5% rule, okay? So that's what we're using right here. And then we're going to do this. And we're going to see how many days could you last if you maximized your loss every single day. All right. And let's build a simple spreadsheet to show you how this works. So here we got, day, balance, risk in dollars. Okay. Which is a 5% risk. And then we'll put up resulting balance, All right, so this is again assuming not just risk, but loss. So we're talking about a really bad trader, like no winning trades at all, okay? Or at least maybe they have winning trades, but they always lose $500. They always lose 5% a day. So the first assumption that is really easy to make is go, well, that means you'd last 20 days because it's 5%. But let's see what happens. Well, look at that. We're going into it, and notice how the losses are getting smaller and smaller because we're on a percentage-based scale versus a flat dollar amount. So now this gets really hard if, you only have $500 in an account. But, so we're going down right here, and we're on day 19. Let's take it one more day to day 20, okay, where the initial, thought would be, well, 5% means 20 days. And you'll see it doesn't because, again, that 5% amount gets smaller and smaller each day. And so right there, we see on day 20, though you don't have much left, you still have 7% versus none of your account, okay? And then if we go down and we continue that down, how far can we go? How many days can we actually go before we're negative? Okay, we went 2 months on a 5% risk, losing every day, losing $500 a day. 2 months, okay? Still going. Notice how much longer you're lasting, okay? 3 months now. So we went 3 months. And yes, we're basically, at the point of being wiped out, all right, which is not fun, but you've lasted 3 months. And that means, and you're the worst trader in the world. I mean, you can't have a winning day no matter how hard you try. And we all have had those days where we felt like that, right? So it's going down, and assuming we're capping our risk every day, which means, our trades are getting smaller and smaller and smaller. But look at this. We're 4 months in right here. Or, sorry, 2020. Actually, we're 4 months in up here at 80. So right there, we're at 4 months in. Now, this obviously, I know is in some ways a little bit ridiculous, but I'm just starting with 10 grand if I put up. It doesn't matter what amount I put up. So we're still going. There's still something in there. You're only trading penny stocks at this point, but, you're still trading. And, so let's see here, going down. And now you could be doing like micro FX, where there's like barely any margin at all. So, you're not talking 1,000, you're talking like $100 at 50 to 1, so you're putting up barely anything. Still going. And still going. Like I said, you're doing penny stock. You do 120 shares of a penny stock, So that's possible. You could keep, doing it just to learn, whatever. So we're going down. Oh my goodness! This is just gonna. I didn't know it would go this far. And we'll stop when we hit. We'll just say $1. All right. Oh, there we go. 180 days. Okay, so if you say just not accounting for holidays, that's 9 months. So if you capture risk at 5% a day, okay, meaning if you lost 5%, you stopped trading. And you came back the next day, and you had 10 grand in your account, you would last 9 months. That ought to be pretty impactful to you, okay? Because the number one rule in trade, the number one, goal in trading is not profit. Okay, it's survival. Because it doesn't matter how much profit you make. I mean, that's your end game is profit. Okay, but to get to the end game, you have to survive. What do you think? After 9 months, you might have learned a few things. And again, this is 9 months of never, ever not losing 5%. Okay, I mean, literally, a monkey could do better. I mean, just randomly go in and buy the same stock every day, and you won't hit that. Okay, so I mean, you're gonna have upswings, you know. So this is really, really, really bad trading. But I'm doing this to give you just the view that by capping your risk, by not being a pig and going in and doing 10 and 20 and 30 and 50 and 100%, or whatever, but by capping your risk at infinite and by doing it on a percentage basis, not only does it give you confidence, I mean, you're like, I could last 9 months doing this. If I'm horrible, I could last 9 months. Just the strength that gives you as a trader. So, and I mean, we can go up here and we could, of course, change the starting amount and, see what would happen. What if I had just, $5,000 in my account? When would I get down to $1? So we go down here and way down. So right here, 168 days, 167, whatever. So if I go in and divide that by 20, still 8 months, okay? Because that 5% rule. So what if I have $1,000 in my account? Then we get down to, if we stop at, $1 here, so the same thing we've been doing all along. You could last, basically almost 4 months. Sorry, 7 months. Wow. So about 7 months. Now, again, we're talking about the reality of, yes, you'd have to be doing a penny stock, to last that long. And we could even go in and say, well, I mean, everything I do is going to cost so much or whatever. But this simple thing just shows you the power of percentage max-based, not letting the sharks eat you alive, risk management. And if you can survive long enough, ideally and by the way, if you have this kind of risk management where you will stop yourself from trading, you're on the right path. Because once you control your risk, then you can start working on managing your profit. But you can't even worry about profit management until you have risk management under control. So you manage that risk. Now you got the piranhas. Okay, what about those piranhas? Well, the piranhas, that's the little trades. Okay, that's the trades in the day. So this is like the risk per day. So like if we had a $10,000 account, say $500 risk per day. But again, what about the risk per trade? And so you can say, you know what, I'd like to be able to, how many trades, because obviously, you don't want to put all $500 in one trade, because that trade loses, then you miss out on like the other 5 trades after it that won, or the other 2 trades, or maybe just the other 1 trade that won. So you're going to have to go in and then you want to divide this out on how much you're willing to risk per trade. Okay? So you could just go in and you could say, you know what, I'll risk, 20% of my risk per day per trade. So I'll risk $100 per trade. And so now that would define that. So that's, risk per trade. So now how do I get my position size? And by the way, what this does is it makes it to where, the $100 is the piranha that's eating you, that's got to cap that. And then the shark is the end result at the end of the day. So after if I got 5 losing trades in a row, I'd be out. Now if I got, 4 losing and 1 winning, well then I'm at, I lost 400, I made 100, I'm down 300, I still have $200 left, and I could pull out the day, So you want to really have that risk per trade. And if we go in and do that, then what we'll see is on the risk per trade, they're $100. Now what do you do? How do you do your position size? Well, let's say there's a risk of, $20 on a trade. Okay? Then my position size is automatically going to be 5. 5 shares, 5 contracts, whatever. 5. Okay? Now, because just depending on how you do your stop loss. Because you got to know your exit before you get in. You're not allowed to enter a trade. By the way, the big rule, do not enter a trade unless you know where your stop loss is going to be and what your profit management plan is going to be. Your profit management plan is not, when I'm up enough, I'll just close. Okay? Because we're going to talk about that. One, the pig will never be satisfied, and the sheep will take it too soon. So we're going to get into the sheep here in a minute. So position size right there, 20 contracts. But what if my risk, per trade, or let's see here. That's not position size. Position size is 5, and risk on the, on minimum size, okay, is $20. And we can throw in there and make all these dollars. Okay, so my risk on that right there is, $20 per trade, meaning I cannot risk less than $20 on this individual trade. Now, the next trade I take on that same day may only be $10 risk. So therefore, I could do 10 contracts on that next trade. But on the total trade, on each trade, I equalize my risk. What's really cool about this is, let's say you get a trade, and it has a pretty tight stop. It's like, $1. I can do 100 shares. Okay? Now, of course, you have to have the margin in your account to do this. But if you have a $1 stop loss, you get to do 100 shares when it's a low amount. So some of those low-risk trades are going to make you a lot of money. Okay? But the goal is to, at least make you $100 no matter what. So a winning trade covers a losing trade, but when you get a low-risk trade, you can do a massive position. And when you're wrong, you lose $100. But when you're right, you make thousands. Okay? And so by combining that and going, okay, what's my cap per day? What's my cap, per trade? What's my risk on this specific trade? Now I know what position size I will do. And versus I'm just going to always do, 50 contracts. Or I'm always going to do 20 contracts. Or I'm always going to do 100 shares every time I do a trade. Man, if you go in and let's just, we're going to blow this number up a little bit. And you only do 100 shares on a trade, and there's only $1 risk per trade, you gave up a lot of money. Let's say you doubled your money, okay? So we'll say we'll say on every position, you made the risk per trade. But you decided, for whatever reason, you're only going to do 100. 100 contracts. But you had you had a $1 risk. You did 100. Now you had a $10 risk. You did 100. Okay? So if you can go in and actually go, okay, based on my risk on the trade's only $1, and I'm willing to risk, say $1,000 a trade, then now, make $1,000 on the exact same trade, the exact same amount of risk. Where it didn't, so I hope that makes sense to you. It's getting that idea of using your risk amount per trade capped, and then how much risk on this trade. Divide that by the minimum risk per trade. So let me restate it one more time. What is my risk per share, contract, whatever? Now I'm going to divide that into my total risk I'll put on this trade. That will automatically tell me my position size. And the cool thing is, the lower risk it is on that individual trade, the more money I'm going to make when I'm right, without taking on any additional risk. So this is part of letting your profits run and keeping your losses, limited, cutting them off. All right, we'll continue on and get more into the sheep side of things right after this break.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, welcome on back here to the Diagnostic Trading Hour. So to wrap this piece up, this segment up before this show closes out today, talking about the sheep. And the sheep is what are signs of you're being a sheep, or that your sheep's sort of taken over. And those signs really are things like risking too small. I only do one contract every time. Now, futures, that's a little bit different, but Nadex, that would be an example. I only do one. Let's see here, 100 shares of stock, because that's what I'm comfortable with doing. Well, as I just showed you, that may not be a great idea. 100 shares with a $1,000 risk, that didn't make sense. So, depending upon what you're trading. So it needs to be, base your size on your risk on that trade, capped at the risk per trade that you set for yourself. And then, the next thing, so that's one sign, is always trade the same size no matter what the risk is. Another one is missing out on a lot of entries because you are constantly looking for a reason for a trade not to work. And I'm not saying that you don't need to have a system and filters in place, but my gut says this, or man, I saw that report, or, you're letting something besides the chart influence you. And also, you probably have 50 things on your chart. You know who you are, okay? And only you can, decipher the magic code, and even you would have a hard time explaining it to somebody, all right? The only reason you have 50,000 things on your chart is because you're afraid to lose, so you're trying so hard, okay, to get the magic system. when the magic system in trading is risk management. Okay, that's the magic to trading. It's not a perfect win record. It's risk management. And the biggest sign, so I'd say the biggest sign would be not taking trades. The second biggest sign, or maybe even equal to that, would be taking profits too soon. And the only way that I know to solve, all these problems is to have a plan in place on how you're going to manage risk, how much risk you're going to have per day, how much risk you're going to have per trade, making your position size based on that, and then trading on the charts. And, I've known some traders that literally they'll hide their P&L from themselves because they know, like, okay, I'm setting this up and this is my risk. They know their risk on the trade, but seeing that fluctuate in P&L, again, it has no impact on the chart. So the chart has an impact on the P&L. So where should you be looking? The P&L, which has no impact on the P&L itself, or the chart, or should be looking at the chart, which has the impact on the P&L? Be looking at the chart. And a lot of platforms, you can even hide your balance, your P&L, whatever. Nadex actually lets you do that. One of the settings that allow you to go in, let me show you this right here. And you can, let me see if I can pull it up real quick before this is up. There we go. Okay, I got it. Let me drag it over. I had it. Drag it over to the screen over here. And one of the things that you can do is right here is you can edit a lot of different things. So you can have open positions, closed positions, but you'll find this handy is there's a section. Let me show you one. Let me put one other thing over here because I want to open it up and just show you immediately the impact versus theoretical. Let's see. I'm going to log into my demo account. I'm going to place just a random trade, so you'll see it in the open position. So if I log in, let's see here. 1 second. And then let me put the position on. Okay. So right here, and I'll do this real quick so you'll get it before the show's up. If I go on, and let's just say, I place a trade for 20 contracts, put it on there, it's in its field. See how my P&L's right here? Hit display, and they're visible columns, just uncheck P&L. And manage your trade based on the chart, based on what you should do. That's one example of how to manage it. Just make sure you do manage your trade correctly. All right, have a great day, and I'll see you tomorrow.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.